This was a holiday-shortened trading week, with U.S. markets closed Friday for Juneteenth. Hey, welcome back to MarketSnap. This week ending June 19, 2026, we're breaking down the biggest stock moves, the sectors that led and lagged, and then we'll dig into a handful of individual names that saw major swings to see if the market got it right. Let's start with the big picture. Through Thursday's close, the Nasdaq led the major indexes, up about 2.4%. The S&P 500 gained just under 1%, the Russell 2000 rose about 1.2%, and the Dow was up about 0.7%. The VIX also eased, down around 7% for the week. So the headline was not a market crash. It was a selective rebound, led by growth, while parts of the broader market remained under pressure. Sector performance tells a more complicated story. The strongest groups were actually defensive or cyclical. Healthcare, basic materials, and industrials all eked out small gains. Utilities and financial services were basically flat to slightly negative, but the real action was in the losers. Energy plunged more than 4%, consumer defensive dropped over 3%, and communication services fell more than 2.5%. Technology also gave back more than 2%. So, while the Nasdaq was up, the strength was not evenly spread across the whole market. The broad market was still under pressure, especially in anything tied to consumer spending or energy prices. Looking at the leading industries, the story gets even more specific. Uranium stocks surged nearly 7%. Metal fabrication, precious metals, travel services, and construction materials all saw gains of 4 to 6%. That suggests money was rotating into niche areas, not a broad-based risk-on move. It's a market that's picking its spots. On the earnings front, we had about 230 reports this week. Beats outnumbered misses by a decent margin, 55 to 34, with a lot still pending. But the market's reaction to those reports was telling. In many cases, even good numbers weren't enough to lift stocks if guidance was cautious. The market is punishing any hint of weakness, especially in the tech and consumer spaces. The macro backdrop this week was dominated by one name, Fed Chairman Warsh. Headlines suggest he's shaking things up, and the market is trying to figure out if he's going to raise rates again this year. The bond market is pricing in a more hawkish stance, with the 10-year yield around 4.46% and the 2-year around 4.19. There's a sense that the AI boom could either cool inflation or stoke it, and Warsh's first big test is reading those tea leaves. That uncertainty is keeping a lid on sentiment. So what does this mean for a long-term investor? A week like this can feel noisy, but it's actually quite informative. The sell-off in energy and consumer defensive stocks might be an overreaction to a single data point or a shift in oil prices. This is where valuation matters. A stock trading at a high PE ratio is more vulnerable to a sentiment shift than one that's already priced for modest growth. Now, we're going to walk through several stocks that made big moves this week. Some surged, some got hammered. We'll look at the news, the numbers, and whether the market's reaction makes sense from a long-term perspective. Let's start with the first one. Stock number 1, Western Digital Corporation, ticker WDC, up 38% this week alone and more than 60% over the past month. The stock is absolutely on fire, but the question is whether this rally has any fuel left in the tank. What happened this week? Western Digital surged 37.7%, making it one of the biggest movers in the entire market. Volume ran nearly double the average, and the storage sector as a whole was up 35%, so the tailwind was real. The catalyst was a string of positive headlines. Morgan Stanley lifted its price target from $488 to $650, and the company showcased AI-focused storage platforms at Computex. The narrative is all about AI data center demand and pricing power for hard disk drives. But here's where it gets interesting. The stock now trades around $750, while our MarketSnap model puts fair value somewhere in the neighborhood of $520. That implies a gap of maybe negative 30%. The trailing PE ratio is nearly 40 times earnings, which is rich for a hardware company. The model's 5-year base CAGR is roughly negative 7%, meaning the valuation is pricing in perfection and then some. Was the move deserved? In the short term, yes. The AI storage trade is real, and Western Digital is a key beneficiary, but the speed and magnitude of this rally feels stretched. Several headlines this week explicitly warned about exhaustion signals and a possible decoupling from reality. The stock has already had a massive run this year. That kind of momentum can reverse just as fast as it built. What to watch next? Keep an eye on resistance levels around $750 to $800. If the stock stalls or pulls back on heavy volume, the correction could be sharp. Also watch for any signs that the AI storage demand cycle is peaking. That would hit this stock hard. Stock number 2, Accenture plc, ticker ACN. This was the week that knocked a quarter off the stock. Accenture plunged 24% for the week, and the one-month drop is now nearly 28%. The trigger was earnings week, ending June 19th. Accenture reported fiscal third-quarter results that actually showed earnings per share up 9% year-over-year. But the market fixated on the outlook. Management trimmed the top end of its full-year revenue growth forecast to 3 to 4%. The official guidance also pointed to pressure from U.S. federal business, while external reports highlighted Middle East disruption, weaker bookings, and investor worries that AI could pressure parts of the consulting model. New bookings also fell short. The stock cratered 18% in a single session, and the sell-off rippled across Indian IT stocks, with Infosys leading a 5.6% drop in the Nifty IT index. Several headlines questioned whether AI is coming for the consulting business, and at least one law firm announced an investigation into whether undisclosed headwinds were already pressuring the business before the guidance cut. Here is where it gets interesting from a valuation standpoint. The stock now trades around $130. Our model puts fair value somewhere in the neighborhood of $220, implying roughly 70% upside. The trailing PE ratio is 10.1 times earnings, which is cheap for a company with a base 5-year CAGR around 12%. Of course, those model estimates swing heavily if growth assumptions change. Was the move deserved? The guidance cut is real, and the slowdown concerns are genuine, but a 24% single-week drop for a company that still grew earnings 9% and is aggressively expanding into cybersecurity with 3 acquisitions this week feels like the market is pricing in an existential crisis that may not materialize. What to watch next? First, whether new bookings stabilize next quarter or the weakness spreads beyond the current pressure points. Second, whether the cybersecurity acquisitions start showing up in revenue growth. If the business holds up, this could look like a massive overreaction in hindsight, but if the consulting slowdown broadens, the stock could test lower levels before finding a floor. Stock number 3, Fox Corporation, ticker FOX. This was one of the biggest large-cap losers in our weekly screen, down nearly 24% for the week. The sell-off was brutal and came on massive volume, nearly 6 times the average. The driver was Fox's announcement that it's buying streaming platform Roku for $22 billion, or $160 per share. Investors hammered the stock, sending it down sharply on the news. The concern is dilution, debt, and whether the two businesses will mesh well. The deal makes Fox a much bigger player in streaming distribution, but the market is clearly skeptical about the price tag and the integration risk. Despite the sharp drop, Fox's fundamentals still look solid. The trailing PE ratio is roughly 12 times earnings. Our MarketSnap model puts the stock around $45, with a rough fair value estimate in the neighborhood of $85. That suggests a potential upside of maybe 75% from current levels. The model also projects a base 5-year CAGR of roughly 12%. Of course, those are model estimates that swing heavily with changes in growth or discount assumptions. Was this move deserved? The market is voting no on the deal's terms, but the underlying business hasn't changed overnight. This feels like a classic overreaction to a big strategic bet. What to watch next? First, any updates on how Fox plans to finance the deal and manage dilution. Second, whether management can convince investors that owning the screen, Roku's platform, is worth the price tag. If the market starts to see the logic, this gap could narrow quickly. Stock number 4, Moderna, ticker mRNA. This stock surged 28% this week, making it one of the biggest movers in the market. The catalyst was a unanimous vote from an FDA advisory panel backing Moderna's experimental flu vaccine, mRNA-1010. The panel voted 9-0 that the benefits outweigh the risks for adults 50 and older, ahead of an FDA decision due August 5th. Volume ran more than 3 times the average, and the stock is up nearly 40% over the past month. But here's the tension. Moderna still has a negative trailing PE ratio of negative 7.8 times, meaning it's not profitable on a trailing basis. Our MarketSnap model puts the stock around $65, with a rough fair value in the neighborhood of $50. That implies limited upside from here, maybe even downside of around 25%. The 5-year base CAGR estimate is roughly negative 5%, suggesting the rally may have gotten ahead of the fundamentals. Was the move deserved? The flu vaccine news is real and positive, but Moderna is still trying to prove its next major growth leg beyond the COVID-era revenue base. The stock has already had a major rebound, so a lot of good news is now being priced in. For now, the market is betting on a pipeline win, but the valuation math says proceed with caution. Watch the August 5th FDA decision, and watch for any updates on the company's commercial strategy and potential production in Germany. That wraps up this week's MarketSnap. Western Digital up 37.7%, valuation stretched. Accenture down 24%, fundamentals under pressure but possibly oversold. Fox down nearly 24%, market worried about the Roku deal. Moderna up 28%, pipeline optimism returning but valuation stretched. These are not buy or sell recommendations, just a watch list for your own research. We encourage you to run your own valuations. Even the same person at different times may come up with very different numbers and assumptions. Check the description for links to our MarketSnap screener and intrinsic value tools. Thanks for watching.